Wes, it is very good to see you. Today, we are talking about Secure Act 2.0 and what it means for your retirement accounts. And you know this already. Secure Act 2.0 recently passed the House with overwhelming bipartisan support. There are many key takeaways and a lot of provisions. So, we're going to walk through what we consider to be some of the more important. And chief among them are changes to our 401ks. What do we need to know?
There are changes to it. And first and foremost, this is seemingly a revenue bill. So those that are in tune with that and kind of can see the writing on the wall,
Yeah.
you can certainly put yourself in a much better position. But regarding the 401k changes, there are things regarding contributions where your employer will be forced to have these plans in which you have a 3% base that will increase each and every year up to 10% as far as the employer match. So that can help you save towards your retirement and it kind of automates it for you. It's great.
Yeah, that is good. And there's also something about having the option to contribute to a Roth. Is that right?
That is correct. So that would be after tax contributions. And if your match is also going to the Roth, which is a new thing, then we just have to keep in mind that that builds up your tax-free bucket even that much more, which is great.
Right.
But don't forget that is after tax, and the employer cannot expense that. So you will likely receive a 1099 at the end of the year. So be sure to keep that in mind as far as what your tax bill will be, so you can make quarterly tax payments.
Right. That is very important. I'm glad you brought that up. Something else that we thought was very important here is changes to catch up contributions. What do we need to know?
Yes, so especially those that are nearing retirement. So if you're between ages 62 to 64, you can catch up with even more contributions, which is now at $6,500 if you're over 50. And then if you're in that particular window, you can actually contribute up to 10,000. So again, more money going back in to help secure your retirement. And Aaron, I'm first and foremost to say that, usually a lot of these bills that come out of our friends at the government, sometimes you scratch your head and you're like, come on. What is this really about? But this one's quite clear to me. While it's designed to help you secure your retirement, it's also a revenue generator as far as tax revenue to the government. So it tells you
Yeah.
the after tax savings.
Yeah, they're not pure altruists up there. We know that. Also, it increases the starting age for RMDs to 73 in 2022 and then kind of staggered then on out. Who does that help?
That's right. So over the course of about the next 11 years is where it will max out to that age 75. But
Hmm.
those that are still working, it allows you to continue to defer those required minimum distributions. But for a lot of our clients, what we're looking here is that, okay, we have an additional window of time to take advantage of this window to convert things over to Roth, whereas before you would have to take that required minimum distribution, whether you need the income or not, pay taxes on it, and then if you wanted to do Roth conversions at that point, you certainly could. But this is a great way to, again, have more money in a tax-free bucket by strategically planning for that. And this can be a little bit confusing, Aaron. So I think it's a reminder to make sure that you're working with a qualified team in this area of retirement planning, because the space is always changing, always being updated.
Huge implications. You are so right. And in fact, that brings us to our last point, which we do want to touch on. Those RMDs will affect beneficiaries when they inherit accounts. And, we've been talking about how this is complicated. So explain what we need to know here, Wes.
Well, basically, you need to know whether or not you're an eligible beneficiary designation or not. Because this is something that after Secure Act 1.0, the financial industry was just like scratching their heads thinking, can you not opine on this, IRS, please, and clarify this? And here we finally have some clarification. Whereas if you are a spouse or not, that could change the way you take the distribution. Or if your designation is a certain trust, it really just depends on whether you fall in that window where you have to take it out over your life expectancy or in that 10-year window, or both. So again, another little muddy piece to it, but make sure that you know it before you're at that age and going into your retirement.
Right. That's why having these conversations early with somebody who is a professional in this sphere is so important. So, Wes, if somebody had questions and would like to reach out to you about all these changes, what's the best way to reach you?
Simply shoot us a message at info@patriotwealthnc.com or hop on our website, send us a message there, and we'll be happy to connect with you.
All right, Wes, that was very easy. Thank you very much.
Thank you.